I mean, I don't know about you guys, but hey, I can admit it. I'm old enough to remember when $1 billion was an astronomical sum of money. Now we're talking about trillions in debt for our country. Check this out.
The national debt, all of the money the U.S. government owes, is currently at $31.4 trillion. But what does that mean?
For one, that's decades worth of government spending. Things like Medicaid and other health care, the U.S. military, food stamps and other benefits, fixing roads, Head Start and schools, the environment, national parks, and 1,000 other areas.
It's simple. For years, what the U.S. government spent on those things was far greater than the amount of money it had brought in to pay for them. That stacked up to that $31.4 trillion in debt we have now. That's an enormous, almost nonsensical number. So let's put it a different way. If all Americans pitched in, it would take $94,000 from each one of us, every man, woman, and child, to pay off the national debt.
Seriously, guys, can you even imagine? Every person, every child in America, each owing $90,000 to service the U.S. national debt. I mean, why don't they just come out and say it? Let's just make it a quadrillion. This way the bar is so high that they don't have to keep adjusting the numbers. Now, I'm just kidding, of course, but seriously, guys, these are the very same people who tell us average people to always stick to our budget and to never borrow more than you can earn. Oh, and what about that emergency fund? Aren't we supposed to have that too? In the private sector, we call that money laundering and racketeering. Maybe some people need to be held on charges of treason. What do you guys think? But really, it's all about this national debt that's gotten completely out of hand. The federal government's deficit nearly tripled in the first 9 months of the fiscal year, a surge that's bound to raise concerns about the country's rising debt levels. The federal government operates under a fiscal year that begins October 1st. And according to the Treasury Department, the budget gap from October through June was nearly $1.4 trillion, a 170% increase from the same period a year earlier. That just adds up to our ever-growing federal debt estimated at over $32 trillion. And thanks to those Fed rate hikes, financing that debt, it just got even more expensive. Interest payments over the last 9 months reached $652 billion, 25% more than during the same period a year ago. And so that basically makes these interest payments the government's fastest growing payment chunk in the national budget. The deficit went up a lot because the government spent more money and got less from taxes. The tax money dropped because people made less profit from their investments last year. So for example, the S&P 500, it fell about 20% in 2022, which made people have fewer gains, and then of course they paid less tax. Overall, the tax money from October to June was 11% lower than the same time last year. Now at the same time, the government spending, it went up 10%, and that includes healthcare programs like Medicare and Medicaid. Social Security payouts, SSI, SSDI, they also jumped 11% because the cost of living, the COLA, went up a lot for retired people and others. Matter of fact, this was the biggest Social Security increase that we've seen in 40 years. And this went to Social Security recipients, SSI recipients, and SSDI recipients. Oh, and remember those bank bailouts? Yeah, $52 billion went into that. So can we really keep up with these skyrocketing deficits? That is the big question on everybody's mind right now. And it's sparking some very serious talks about how we handle our money. Now, just to really bring it home for everybody, the forecasts show that we might end up spending more on paying interest for our debt than on the whole defense budget in the next 10 years. I mean, seriously, can we afford to let things keep going on like this? Even when we had that showdown over raising the debt ceiling not too long ago, it really didn't change the big financial picture here. Now, sure, there was a deal to avoid a government default, but all it did was put some limits on how much money we could spend on everyday stuff, like discretionary spending, which isn't really even the biggest part of our budget. And let's be real, guys, the whole deficit thing is like a powder keg in the world of politics. You got the Republican Party in Congress saying a big fat no to pretty much any kind of tax hikes, while the people at the White House, they're battling against the idea of cutting back on important things like Medicare and Social Security. Now, I think we have to take a very hard look at everything in the federal budget and just figure out what's what. The Fitch bond rating agency dropping the country's credit rating definitely did not help either. It's clear we need to step up our financial game before things get even messier. But what do you guys think? By the way, if you own a home, make sure your home is protected. Get your free home warranty quote. There's a link in the description down below of this video. video. By the way, if you guys are finding our financial updates helpful, don't forget to give this video a thumbs up and also hit that subscribe button. Appreciate that. But now let's get back to Fitch. So you might have heard about those US Treasury bond yields shooting up lately, and everybody's pointing fingers at Fitch's ratings downgrading America's credit from AAA to AA+. But here's the thing, guys. The media's kind of got this cause and effect mixed up. They're saying the yields are jumping because of the downgrade, but it's more like the US government's racking up a massive amount of debt. I mean, we're talking a cool $1 trillion just this quarter, and that is what's pushing those yields higher. Now, Fitch's move to give the US a lower credit rating is more like following the crowd than leading it. This sort of thing happens with credit rating agencies. Y'all remember when Standard & Poor's did something similar back in 2011, right? That's most likely why the recent downgrade really isn't that jaw-dropping. The markets pretty much saw it happen before, and we're still okay. Now, as veterans in the markets usually say, a AAA rating is just waiting for a downgrade. But let me tell you what this really means. Those letter ratings, AA+, AAA, whatever, they're not the be-all and end-all. It's the numbers that count. These ratings, they're basically some experts' guess on whether or not the borrower, that's the United States in this case, can and will pay back what they owe. And in both Fitch's and S&P's evaluations, they're worried about the US playing political games with debt obligations, which is not a good sign. That means traders and investors are moving to safer assets, and they're pushing up the yields on the longer-term US government bonds. And those yields have not been this high since last October, and that is causing bond prices to drop. Now, sure, 10-year and 30-year Treasury yields, they've cruised past the 4% mark. Now, of course, we're coming out of some seriously crazy low yields after the whole C-19 mess. And you know what's really getting the market's attention? But the market is beginning to anticipate a continued rise in bond yields, which are based on U.S. government borrowing costs, which sets the standard for interest rates. Treasury Secretary Janet Yellen, she wasn't too happy with Fitch's not-so-great review of our country's financial situation. She said their information's outdated and it doesn't give the United States economy enough credit. But despite the economy supposedly looking resilient with the jobs market and all, the U.S. is still diving deeper into debt. Now, instead of pointing fingers at Fitch, maybe our government should take a look at what's being said. Fitch's numbers are not based on nothing. Take 2023's deficit, for example. It's already sitting at a whopping 6% of our total economic output. Now, that's usually the kind of number that you would see during a recession, like when things are not so hot and the government's spending more on things like unemployment support. And the outlook for the future doesn't look any better for the out years. The Treasury recently announced expanded auctions of every maturity, including this coming week's sale of $103 billion of 3, 10, and 30-year maturities. Now, at the same time, the Treasury's also announced increases of every security from short-term bills to longer-dated notes and bonds, as well as floating rate notes and inflation-protected securities, which is at the very core of the current backup in yields. Now, this comes as the Federal Reserve is selling off its holdings of treasuries and agency mortgage-backed securities. Foreign central banks are also reducing their cash of U.S. debt, all of which means more paper for the private market to absorb. Now, down the road, the Federal Reserve, they might not exactly live up to the expectations of both Wall Street and regular folks like me and you. I mean, we could go the cut the spending or raise taxes route, but those ideas are not exactly getting those 2024 votes, you know what I mean? Then again, there have been historical solutions like in the post-World War II days when we were dealing with a mountain of debt. It involves a mix of a couple of things, inflation and financial repression. So financial repression involves all sorts of institutional arrangements that suppress borrowing costs for the government, kind of like negotiating interest rates down for the money we owe. And on the other end, inflation boosts the aggregate economy with higher prices and wages measured in less valuable dollars and generates more tax revenue. So experts boil it down to a tax on bondholders and savers. Now, the Fed's all about bringing inflation back down to a 2% target. But why is 2% like the holy grail of numbers? Some economists say that why not 3%, which is kind of like right about where we're at right now. Wringing out that last bit of inflation could come at the cost of higher unemployment, and it might not necessarily be worth it. And that extra inflation, it would swell government revenues. The financial world is definitely cooking up something very interesting, guys, and it's all about finding that sweet spot between keeping the economy humming along and not letting things go haywire. Down the road, it seems like governments in the G7 group, they're all taking a leaf out of Japan's playbook. Bank of America's Global Investment Strategy team, they're predicting that financial repression policies like Japan's yield curve control will be adopted. Now in Japan, The Bank of Japan uses a plan called yield curve control, and they're using this to manage how much it costs to borrow money for a long time. And they do this by buying or selling government bonds to keep the cost at a certain level. Now, this helps keep borrowing costs low and it encourages spending and growth. The idea is to fight against prices going down too much, deflation, and also to keep things stable for investors even when interest rates are very low. They're thinking something like this would actually kick in once the recession provokes fiscal policy panic and even higher government default risk. But the problem with the long-term US bonds isn't just about quality, as the Fitch downgrade suggests. It's more about the sheer quality needed to cover the ever-widening budget gap in Washington. And as if that wasn't enough, the expected normalization of interest rates is piling on the cost. Market players are making that point, and thus the news, that's what's making headlines. And so basically this Fitch downgrade move, it's shining a big old spotlight on the ongoing tug of war in Washington over the ballooning federal debt. I mean, we're talking about debt levels that haven't even been seen since like World War II, guys. Fitch, along with a lot of nonpartisan experts, they're all raising these red flags about how our national debt is just skyrocketing, and it doesn't look like it's hitting the brakes anytime soon. Now, why the downgrade, you might ask? Well, Fitch, they're pointing their fingers at all those tax cuts and spending sprees that have been happening for decades. And they're not too convinced that Congress is going to be rolling up its sleeves and tackling this debt beast before the 2024 presidential election. So yeah, it's a bit of a political and financial conundrum. This whole debt situation could be a bit of a thorn in President Biden's side, as if he needed another. He's been doing some victory dances about how the deficit went down after Trump's exit, but here's the kicker, guys. He's still got a massive debt load hanging over his head, and it's not planning on shrinking anytime soon. Now, on the bright side, you got Biden's inflation strategies. They've helped take the edge off the debt's impact on the economy. And of course, those interest payments as a chunk of the economy are currently keeping things relatively calm, at least for now. But here's where things get dicey, guys. Experts are raising their eyebrows and they're sounding the alarm about those long-term debts. Over $31 trillion and climbing. And nobody's really sure how Congress is planning on tackling the funding issues for major social programs like Social Security, SSI, SSDI, and Medicare. Are they going to cut people's benefits? Are they going to raise the retirement age yet again? And of course, Republicans and Democrats do what they do best. Blaming each other, pointing the finger for, America's problems. But despite all of the finger pointing, lawmakers, they're not exactly jumping at the chance, putting forward plans to deal with the monstrous deficit.